Hey everyone, my name's Andy from the Finding Value Finance channel. Today we've got TraderFerg with us. Got him back on, wanted to get his opinions on 2022, also on 2023 that's coming up. So thanks for coming on, really appreciate it. I know you've been on here a couple times. And if somebody wants to follow you, we'll just get this out of the way in the beginning. They can follow you on Twitter at is it at TraderFerg? Nothing else, right?
Yeah. Just underscore.
So
Yeah. TraderFerg.
so
Thanks for having me
looking
back.
Yeah, definitely. So looking back at 2022, what are some things that maybe surprised you? What are some things that you thought maybe went poorly or went well? What are your thoughts looking backwards at 2022?
It was kind of like just a trying to hang on to it year for me. Like I had a great few years before that. I knew there was going to be one year where it was going to just try and hang on to the gains really. So for me, I think I ended the year down. I think my official figure was like down 12%, but that didn't really even reflect how, like, from the all-time high in my account, it was more like down like 25 or something. And so it's just like running quite big concentrated positions, just accepted there'd be more volatility. But yeah, no, happy overall. The big question that I keep coming to, and what the sort of debate I have with my mentor constantly, is just how concentrated to get, because that's like it's no longer. See so many debates at the moment about like how people are like happy clapping about their commodity doing well versus the NASDAQ or the S&P, but it's really coming down to just a commodity versus commodity comparison, like which is going to be the best performing sort of asset within this whole space. And that's what I spend all my time trying to work out. And it's interesting now, like yeah, had some great runs, but is it time to kind of roll out of them? Like an example is coal. So I had a fantastic run on that, and my mentor was fully out of coal. So and he's kind of going heavily into sort of the offshore services. And I don't know if it's sunk cost fallacy. I put so much work in, and I'm sort of still hanging on to my Peabody, my Whitehaven, and yeah, it's that reassessment is how much am I leaving on the table by just sort of hanging on to a trend when there's probably more asymmetry in something else. And you're also just seeing signs of when something comes to everyone's attention. Like coal's a great example. So I had a lot of people I hugely respect and very knowledgeable in the coal trade. There was a lot of good arguments for why they like in say New South Wales, they wouldn't get sort of attacked by government. There was so much time before they could even think about following like Queensland's case, like slapping them with royalties, and yet here we are, and they've already, like, a lot of the names they now have to supply at least 10% at a fixed price for domestic production, which is essentially the same sort of deal, like just stealing from them. And even though the logistics make no sense, it's again it's short-termism, because you take a hit on the short term, but it's making the long term even better, so making you want to stay with it. So yeah, honestly the hardest thing is just deciding where to position in the energy space is and some of my love trades, I'm like kind of sharpening the knife to see if they're going to survive. Like tin's a good example. That's one that I really love it in the portfolio, but at the same time I'm kind of seeing so much value. Not so much in uranium, because I'm up to my eyeballs in uranium anyway, but more in the really kind of pushing the chips in with offshore services and even just the future options to keep it simple. So yeah, that's kind of where I'm at currently. Dive
Yeah,
into all of that. Yeah.
and why do you like so much, and why are you focusing on the offshore services specifically? Like, what makes that sector so attractive to you right now?
So the thing with a lot of this is it's kind of easy to make the upside case, but upside's always it's always like hindsight. What like I can make a strong case why uranium will be the most sort of parabolic move, just because of the size, capital kind of squashing and trying to cram into it, the fact that it can be sort of greenwash a whole lot of ESG portfolios that have screwed up going long EVs and solar and wind. They can try and save their performance with uranium and just nuclear. So there is that side, but you don't get the margin of safety. So we were talking about before that when you go into like the uranium miners in particular, you've got all sorts of risks. You've got geopolitical risk. A lot of them are sort of in Africa, and so you're running that risk. You're running sort of execution risk. A lot of them are trying to develop mines. You've got cost inflation. A lot of these guys had to revise, even the guys with infrastructure already in place, had to like put up costs like 30-40%. Like you got Kazatomprom and Paladin, both 30-35% cost inflation. So needless to say, the guys that haven't even broken earth, they're gonna have a rough time when they come to doing this. So yes, the upside is definitely there, but the margin of safety is a lot harder. So that's where I definitely see where people are coming from, where they say just don't go with the miners, just go with a split, just go with physical. But then yeah, you are giving up a lot of the torque. And so that's where the offshore service is so interesting. Is I think the upside's still there. So they can certainly move if you look back at prior cycles. But what's more interesting is just the margin of safety is really substantial when you consider they've been through a bankruptcy cycle. That majority of them have restructured. A lot of them are sort of net cash, and it's really just inflecting now. And not only do you get the upside, you've got this dirty big margin of safety, so you don't have to take much risk, which is the argument why you can really size this stuff up. And that's the opportunity there. Is there's not many times that come along where you can get huge outperformance without having to take on a lot of risk. Like everyone, kind of the hindsight is always the sort of Rick Rule story of patting yourself on the back for buying Paladin at 1 cent, but of course the risk was fucking massive. There was a very high chance he dusted all his cash on that. It's the more respectable story is the one where someone loaded up where it was like a net cash and still made some 10x like that. That is the game. That's what you got to hunt for. And so that's what I think is presenting us now, and that's why I'm sort of having this big internal debate is how hard to push this one sector when we've got this sort of a setup at the moment, and you can go down all the angles with it as well, because it's all quite noble as well. The mistakes I've made is where I thought I could have understood the margin of safety, but if I couldn't write it on a napkin, it's just really, really easy with a lot of the offshore drillers, the Tidewater. Like you've got these guys that have just written off billions. Like I've got a chart that's like 25 billion of write-offs, and it's not like a sort of a tech company investing in like a silly project and it gets written down to nothing and you haven't got anything. Well, these guys put say $1 billion into rigs. You've still got those rigs. It's just been written off the balance sheet. So you've still got all that embedded energy. Share my view, energy costs are going nowhere but up. All the commodities that go in are going nowhere but up. All the specialized labor, most of these guys are being laid off. So got to retrain them, rehire them. Most of the shipyards got stuck with all this stuff. They've all gone bust, and the ones that have survived are all busy making have been booked out for LNG, for container ships, and it's that margin that makes it so attractive. Yeah.
So the way that I view things, I look at risk reward, and then I look at the probability of the outcome. So
yeah,
I think what you're saying is exactly what I look for in potential investments. I talk about this a lot on the website with a lot of people. What you want is things that have infrastructure in place that can generate cash flow, and you just want the timing to come back, an out of favor sector coming back into favor, and all that cash flow can be generated because the infrastructure is already in place. So the probability of them generating cash flow when that comes back into favor is ultra high because they have everything there. You just need the market conditions to change in your favor. And that's exactly what I do is I size up my bets um, on the big side, or I overweight positions that have that setup. In uranium, it's exactly like you said, they have to do everything from scratch. But I go back and forth with uranium because uranium's more about money flows and just people aiming at it and throwing money at it, right? Because
Yeah,
I
yeah.
mean, they throw hardly any money at it and it goes up, $1 billion. It just blows up the whole market. So, what's your opinions on the uranium market, and kind of what are some things that you see in there that may attract somebody? Is it, I mean, that's what attracts me, but is it the same thing that attracts you to the uranium space?
Uranium's hard because I was like beating the drum with uranium back when I first kind of jumped on social media, and because it was just you get so much like margin of safety just by being early. So that's why I don't really like talking about uranium so much, because I kind of feel I'm doing people a disservice if you like talk about X company at $1 when you got in at 10 cents. Like it's not as helpful, which is why I like to push the offshore narrative as much more, because most of these things are, so yeah, some of them are really starting to run, but most of them are still only sort of 100%, 200% above sort of their lows. And so you've got that initial ramp. But yeah, the story of uranium, I think I mentioned before, is just it's just it's just so tight. Like I think I talked about forces when I was like looking at the volume, and someone just putting, I think it was 200 grand in a day. This is back in, this might have been 2020 or 20, started 2021, 200 grand and move the thing like 12, 13% in a day. Like you just once this narrative takes off and the capital comes through it, it's just going to be squeezes. Like you got a taste of it in the squeeze, whatever it was 2 years ago, and it was just people saying, "Oh, I'll get in when it starts to look good," or it just does sort of 10-15% days, like a week or two at a time, and that was just my experience with it. So it's sort of I've hung in there, and I have this debate with my mentor, because he's actually completely sold out of uranium, and makes a lot more sense if you're more risk adverse. But I've just got such an early cost base, so I've got that margin of safety that yeah, I really want to see it through till I see the spot price at least north of 100, somewhere where I think it's sort of going to incentivize more supply. That said, I did go through with a sort of an axe and really took to a lot of the guys that were, a lot of the companies that I thought cost inflation would be pretty harsh on them. So looking to concentrate a lot more on the sort of the retired mine side, and that already just got the infrastructure in place, so it kind of helps protect you. It's sort of a theme throughout my whole portfolio, is I love the restructurings or sort of retired mines, just because I don't back myself on knowing any of the sort of who's going to be better at bringing a mine to operation. Sure, I've got a little bit of it because I know it's torquey as hell. They're more like call options in my mind, just call options without sort of the time decay. But yeah, for serious positions, it's all these guys that have just ridden off a ton and have a lot of hard infrastructure in place that's going to give them a massive advantage as cost inflation keeps ramping. And yeah, all these guys are going to have to compete with that in place infrastructure that doesn't largely have like a cost line to it, because it's been written off. It's been like, yeah, I love the examples. I'm forgetting the name. I think it might be I don't think it's Winchester. Like Peabody's got a great example. I think they went out and bought the forgetting the Met project they have in Oz, and they bought it for $5 billion, and then they wrote off $5 billion in the bankruptcy. So after emerging, they've got that project for free. Yeah, it's just that you got subsidized by the previous shareholders, so you've got that cash flowing moving forward, and yeah, you get to benefit from that. And so that's what my portfolio keeps trending towards. And where I do go for optionality, I'm just trying to cut out all the risks. Like I'm just so concentrated on, I just really hate it when I have when I'm right on the overall trend, and I just get taken out because of some execution risk or some dumb thing where you just get cleaned out. A good example, I got cleaned up on Saipem because they went into offshore wind quite heavily and then had a mass cost overrun and then blew up a third of their equity, and then pretty much had a restructuring, and I've had to suck it up and go again. But yeah, just avoiding those, or I'll accept a slightly lower sort of payoff as long as I keep all my capital on the table. So I think that's going to make a massive difference over the next sort of 3 to 5 years. Yeah.
So I know that you're debating and maybe figuring out how to size up some of your portfolio. Can you talk us kind of what you're considering when you're doing that? I mean, what are you looking at? How are you evaluating these things? And when you say like sizing up a position or how big you might go into it, like how big is big? Is it like 20% of a portfolio, 10% of portfolio? Like what does that look like?
Yes, I've got position sizing, something I never really have down. I'm always trying to optimize. I think I change my mind on it every few months. It's like they say, like you've sized something perfectly when it runs for you, and you've sized it in hindsight, you hate yourself when you size it up and you get it wrong. It's always kind of position sizing is always hindsight, whether it worked out or not. But my general rule is I always kind of, my general position size is somewhere between sort of 3%, maximum 5% on position. If I really see just a ridiculous setup, like it might be an example where I would really push it, as if, I don't know, someone came out of a restructuring, got relisted and was just trading for a silly, I could see a silly margin of safety that I might push it up to 10, but that's very rare. And then per sector, I usually try to max it out at about a quarter, but then that's got super out of whack at the moment just because stuff runs. And yeah, it's all kind of, in theory, this would be what I would do if I would start again with cash, but the reality of the situation is when stuff runs, it just massively skews your portfolio, and then you have a whole lot of risk that you don't really want, but then I don't want to sell it either. So yeah, it's
I had the same thing. I bought all the oil exploration production companies at the bottom, and it became like 60-70% of my portfolio.
yeah, it's like me. I always joke, I talk about risk management, and at some point I've got over half my portfolio in Namibia. If I have a coup in Namibia, I'm in big trouble. Yeah. So yeah, that's sorry, I lost train of thought where I was like going with that.
Here's another question. So let's say you've got it, it runs a lot, it goes up, it's like 50% of your portfolio or greater. When do you cut back? Because, you know, I'm the type that if I see something and it's that everything looks good, the fundamentals are still good, and it still wants to run, I kind of let it run until I find a better opportunity. What about you? How's your approach?
Yes, for anyone that hasn't read it, go pick up this book called The Art of Execution, and it's this it's a great book by this fund manager of funds, and he just goes through a whole career of observing all the hedge fund managers he oversaw and the guys that produced big returns. The ones that did were the guys that could just identify trends, take a large position, and then just keep adding to it on volatility and just really ride it. And like, just, I think like the takeaway is it's just so easy to talk yourself out of a good thing. And when you've got a really great entry price, just sticking with it. There's obviously all the optimizing as well, like obviously tax and whatnot. It helps just to really ride it. But yeah, that's always in the back of my mind. There's just I've got a blog post on my blog that's I always refer back to, that's got kind of a lot of my exit signals for getting out of uranium, and we're nowhere near any of them. Like, it's just you've got kind of divided it between half of it's like behavioral and half of it's just like sort of market factors, like need to see spot overshoot term by at least like sort of 20%. You need to see the term well above like the incentive price, whatever figure that is at the time. And then like the behavioral would be sort of the old sort of everyone talking about it at a barbecue. It's all over CNN. It's you got like sort of the Cathie Woods of uranium. You've got the taxi driver trading uranium stocks on the iPhone, like all that sort of stuff. And we're so far from that. So I kind of, as you say, the only reason to get out of it is like what my mentor Brad's done and sort of jump across because there's a superior risk reward. And that's what I battle with, is the idea that there could be a superior risk reward, but I still think like, yeah, getting in early and having this kind of, there's a lot of tailwinds. There's a lot of tailwinds to both. I honestly think it's a coin flip. I was just reading before I jumped on Cuppy's latest piece, and he's just like, he's got this one piece that he's just wrote this, like, I just don't know what's going to happen in the coming months. Like, so many things that could go either way. But the only thing I know is that he's sort of staying balls to the wall, offshore and uranium. And that's similar to me. The only thing I'd add in is I still got a big chunk of coal exposure. I kind of almost put my future options on oil in with my offshore, because I kind of view offshore as pretty much a call option on oil in itself. The only one that I kind of look at every now and think maybe you might get the chop, even though I still love the whole thesis, is tin, just because maybe a lot of these sort of, if you got OPEX commodities and CAPEX commodities, maybe these CAPEX, a lot of them are like further down the line than the OPEX. So the OPEX kind of runs first, and then a lot of the sort of cost inflation feeds into those. So maybe roll some of the profits forward and still capture it. So yeah, probably the one that might be under the chopping block first would probably be tin. So yeah, that's kind of all the thoughts rolling around in my head at the moment.
Yeah. What about recession and your thoughts about a recession? Are you just going to hold through if we have a recession, or are you going to try to time this stuff? What's your thoughts around that?
So I've got a few pieces I'm actually working on at the moment, because I've got really no cash. So I've just this new place, just had a baby, like yeah, gone through all my discretionary cash, and the rest of my cash all kind of went into oil positions a while ago. So probably the lowest cash position I've ever been. So by default, I'm just going to have to ride volatility until I can build it up just from income, and hopefully dividends, and I make a decent amount just writing covered calls on a lot of the positions that I think are more mature. So that's always been a big I've always been a big proponent of covered calls on like coal. Like I write a lot of covered calls on like the likes of Peabody. It's like when you have really high volatility and you think the sector's kind of, the run's matured a bit more, then there's a great opportunity to produce income from that. But yeah, generally it's ride through volatility, and what I'm really hunting for at the moment, so what I'm working on is trying to figure out some ways to get some real like some good tail risk hedges that could produce cash in a bit of a bust up. So I had a bit of success with it going back a few months, where I had Robert Mullen on from Marathon Resources, and he had a short trade. He was just like, yeah, we're running low level of cash, but we really like the short side of the US utilities. Like, just everything else green is kind of taking a hammering, and these guys are just sitting all-time highs, and the vol's super cheap, so it wouldn't be hard to make a good return on that side. And it's not so much hedging your portfolio, it's just producing cash when there's a bust up, and you can put it to, it's almost like the return's just a bonus. It's what you can put it into at that time. That's the big win. And so that came off, and that was like, that gave me, I think I only put like 0.5% or something into it, maybe a bit more, but that gave like an 8 times payoff, and gave me cash exactly when I needed it at the time, and put that into some rig, put that into some more option futures, and that's where the real returns come off the back end of that, something that you can ride for another few years. So I'm trying to hunt those out at the moment, and yeah, I've got a few ideas for them, but I've still got to try and, yeah, structure in a way that makes sense, that you're not just wasting money, because it's also, if you're running low cash, it kind of just annoying, like burning premium. I hate burning premium. It just hurts my soul when there's so many good opportunities, and allocating sort of a percent where, you know, you could have put it into something that you got real faith in, you just burn it an option premium, that hurts as well. So it's again, it's trying to strike the balance between some hedging for a good sort of outcome and cash injection, and not just accepting the volatility and just putting it somewhere that you've got absolute conviction and accept, yeah, my account will bounce around, and if it gets really nasty, I'll just try not to look at my account for a month or two. Yeah.
That's kind of what I do, I guess. So you're doing a little bit of hedging. You're trying to generate some income, get some cash flow. And if we do get a crash, you'll just see it as another buying opportunity. Is that
Yeah.
fair
Pretty
statement?
much. Yeah.
Yeah.
There's just no way to get sort of taken out. Like, I don't run any leverage, any margin really. All my leverage is from the companies I pick, or just options that yeah, there's no way I can kind of get knocked out of it. Even when I say income strategies, it's pretty basic stuff. I'm just doing like covered calls, and yeah, it's there's no sort of selling naked puts or anything, or calls or anything that could screw me up in a big vol event. Yeah, it's something my mentor Brad taught me early on. It's just, you just always want to be long vol in every way. Anything that makes you short vol in your account is just sort of opening you up to Murphy's Law, and you just don't want it. Like, I just had enough in life that anything you don't think will happen. I remember I had it when I was started playing with futures. This would be like 10 years ago, and I explained my whole thesis to my old man about how it was at the time, because the Euro Swiss, it was like you can play around with Swiss interest rates, and it was how they were saying that they would hold it at zero, and I was like, oh, interest rates have never gone negative in all of history, and so can kind of leverage it up a bit on the zero bound when it touches it, and of course, anyway, they go all the way to, like, what was it, 75 basis points below negative, and completely blew me out of that trade, and cleaned up about a year of salary at the time. So I've always kind of remembered that from then on. Is just, don't try and be too smart. Just, as Brad likes to say, just position yourself to be lucky. If you've always got sort of asymmetry, optionality on your side, you're just constantly focusing on the margin of safety side, and just let everything else play out, and then have a solid exit plan. So that's probably the worst. It's joining a cult on the other side of this. Like, we'll probably see like Uranium running around with green laser eyes, and people shouting at anyone that say to sell. So just, yeah, that's how I'm thinking about
it. And I know that you're obviously an oil bull, so am I, or energy bull just in general.
Yeah.
Is there anything that can stop this thing in the short term? Outside of, I mean, long term, it's supply, if it were to bring on supply. But I mean, would a recession prevent you from buying any of these energy companies? Or, I'm trying to think of a lot of people who are kind of retail investors. They worry so much about the short term that they get scared out of everything. And I don't worry that much about the short term. I just kind of ride all through it. I'll buy the bottoms, or try the best to buy whatever and accumulate when it's cheap. What are your thoughts around all this? Like, is there something that could stop it, where the retail sector is actually right? I can't think of anything myself. I just kind of ride through a recession. Recessions don't last forever. It might last for a short period of time. Yeah, it could be painful. What are your thoughts around kind of that whole area, I'll say, in terms of if something could stop it?
I see there's just opportunity. If there's a good bust up and you get some crazy volatility, like there's nothing quite as beautiful as having done the research on a company or a sector, and you see it just goes from fundamentals to just absolute like liquidity squeeze. Like, it's what we had in March 2020. That was once in a decade, when I just saw stuff like, I was like, this is cheap, okay, and then it gets cut in half again, like, what? And then it gets cut in half again, like, Jesus Christ, I thought it was like I was buy the century like 50% ago. Yeah. And so, yeah, when I hear that, but it's just, it's having the mental fortitude to buy. So it's always loved the kind of like, I think it's like the conviction thing. Like if anyone asked me, what's your conviction on this, doing this in like 6 months time, like, Jesus, I don't know, like not even probably a coin flip. Like it just having, yeah, I've got no idea what will happen in any sort of short-term time frame, but it kind of builds up to a reasonable amount, probably 1 to 2 years, and then get pretty damn high conviction, sort of 2 to 3 years. And that's where I've always made all my money. I've always, that there's something special about that sort of 2 to 3 year time frame, especially towards the end of 3 years. Like that's when stuff, like you've made your first like sort of small gains, and then suddenly they just start really stacking up, and the asymmetry just really kicks in. But yeah, I think as per what Cuppy said, like I just don't know. Like if you listen, there's a great podcast a little while ago with a guy called Mike Taylor. He was on Grant Williams' podcast, and just like just the fact that currently the numbers just don't stack up with the amounts of the sort of the Fed's sort of treasury holdings that are coming due, and the amount it's jacking up the interest expense.
Yep.
Like they just can't have it. Like they're so, what is it, it's like 60 or 70%, like inside 3 years, they can't let that jack up. If anyone wants to read, Horizon Kinetics released a great piece on as well. They break it all down far better than I could, but it's just like seeing someone not be able to afford it, and like ultimately the Fed, if their real mandate that no one will ever talk about is they've got to make their treasury look solvent, and so ultimately pretty much has to kind of engineer some sort of a crash, recession, whatever, to bring that cost back down. And then on the back end of that, of course, they can't afford everything moving forwards. They have to open the printing press. So you've got this, you can understand that broadly, but it doesn't really help you map out what will happen over the coming months, because you got all sorts of systematic risks. Like I was listening to Louis Garve, he's talking about how no one's really figuring what will happen with a lot of the corporate grade debt, because everyone kind of goes back to the 2008 period, where if anyone gets downgraded, you've always got like a JP Morgan willing to step in and offer you sort of 55 cents, but that's all been regulated away. So it's a lot of the stuff is just free fall. And that's pretty systematic in itself. Similar to the passive, like everyone loves it when it's getting kind of cornered and going up day after day, but without the market makers and a lot of these high frequency guys that just, if stuff gets dodgy, they just stand aside and say, I'm out, I'm not going to touch this. Then you'd see some pretty crazy erratic prices and a lot of stuff sort of blow up that's not based around it. So yeah, I think it could be a crazy few months, but it shouldn't affect your outlook. You should just do more work on the fundamental outlook and just accept it's going to be a rough ride. There's going to be lots of ups and downs. There's going to be lots of fake victory laps. Like it's probably a good chance if the Fed does sort of kick off printing again. A lot of the sort of the ARCs and the crypto stuff will go vertical for a while. But as I've always said, like just stay in stuff you can ride for years. That's where it is. Like know your margin of safety and know stuff that's going to continue outperforming, because that's where the big outperformance is going to be, like just absolute hanging in there with energy. Because going back to like the coal analogy, like you can get screwed up and everyone like sort of gets annoyed when by the Whitehaven example, like step in and tell you to sell 10% of your coal for $120 a ton instead of the current market prices. But that act in itself is just meaning further down the line, the price is going to have to be even higher. And just every short-termism is just deferring more investment, and it's just meaning that future incentive prices is going higher and higher and higher. And it's just trying to work out which commodity is going to benefit the most and which one is going to be the most unmolested as well, which is why I kind of like offshore as well. It's kind of so diverse, it's kind of, and being a service, it's not as easier target is something, say like a coal mine in Australia, which is just sitting there pumping out cash, and politicians just can't keep their hands to themselves. So yeah, that's just ride the volatility, I guess. Is that's again, keep coming back to that, have conviction and ride the volatility.
Yeah, that's what I do. I take a long-term time frame. I got a really good entry point in a lot of my, 2020 and whatnot. And I've just been riding and adding on the dips and whatnot to accumulate bigger positions. Yeah, so I'm of the same ilk, so to speak. So looking at the oil cycle and kind of looking at all this stuff, and I've kind of contemplated this quite a bit as well. I do have a good exposure to exploration production companies, and I've been adding a lot to energy service here recently. Who do you think is going to make the money on this thing in terms of oil? If oil goes up, I mean, obviously the governments are going to try to steal whatever they can, but who's gonna end up making all this money? I mean, do you think we're close to peak oil? And what really would happen is if we hit some sort of peak, all the energy service companies are just going to make like money hands over fist because they're going to drill more and get less. They drill more and get less oil, so to speak, in terms of productivity per well and all that stuff. Who do you think is going to end up with all the money, and what sector do you think is going to do the best?
Yeah, well, I think it comes, if you come back to that idea as well, the Fed's just going to, anyway, out, so they're just going to have to print, like all roads lead to more printing. Then it all just becomes a hunt for the scarcest asset of all. And so in a world where see energy being constrained for years to come, then the assets with the most embedded energy that have had the biggest write down, I think, will be the biggest winner. And so all of that's kind of a complicated way of coming right back around to offshore services and just looking at a lot of the rigs that have just had write downs. And from there, it's also doing the work to decide, like, you can kind of the comparison of the likes of like Valaris, where you've got a massive margin of safety, but not quite the upside of something like Transocean, which you've got a ton of assets, but you've got a dog shit balance sheet. Then also all that debt is torque and leverage. So with the fundamentals improving so quickly, like it becomes an easier call to make. Oh, sorry. Becomes an easier call to make. And also, that's kind of what I'm trying to dig into at the moment, is where the most value is within offshore. Like it's just constantly niching. So it's niching into commodities, what's the most hated and where's the most value in commodities, and finding that sector, then what's the most hated and where's the most value within that little sector, and just constantly going down. And so with what we're seeing now, like some of the biggest winners are the ones that a lot of like the support vehicles, because with the likes of like drill ships, and they're pretty self-sufficient. So when utilization is low, there's not a lot of need for all the like OSVs and everything around them. But now that utilization for drill ships might as well be 100, I think, plus. Looked, it was like 95 plus. And then for deep water, you have to move on to semi-subs, and then you need all the support infrastructure because semi-subs are fixed to get deep water. So all that stuff takes off as well, and hunt through them. And you've got guys like Tidewater and stuff that have all gone through a bankruptcy, and you've got a good margin of safety there. And yeah, like I think when I first bought them, I think they were I worked out the replacement cost was like around 10%. And a lot of these guys are constantly bringing down their book value and replacement cost. So it's not even really stated. Like you can look at someone like, it's always interesting to look at someone like Transocean that hasn't gone through a restructuring versus the likes of Noble, Diamond, Valaris, Tidewater, all the guys that have, and how much just how much cheaper, and trying to like answer the question, like how much will you actually be able to reproduce a drill ship for in the future? Like some of the CEOs are saying like, oh yeah, I can't see one being done for built for like $1 billion, and it'll be $1 billion plus, and on what time frame, like with the yard capacity. And I believe Transocean just had one delivered, it was 1.2 already. So I see a lot of the value they're subscribing their current fleet is just going to be woefully like the sort of mean reversion trade back to what they think sort of fair value. I think that'll get completely blown out the water as well, just because of the whole embedded energy, the whole like just all the input costs. And another interesting one is just the you listen to some of the old hands in the sector, just all this all the specialty labor's gone. Like you listen to like John Borstoff and Uranium, sort of said what's the biggest constraint there, and everyone's always expecting to say sort of I don't know, like yeah, capital or getting
Loans or something like that.
Yeah, but it's everyone's left the sector. They're all old. They're all in their 60s and 70s, and they're all everything's been downsized, and they're all retired, and they're not coming back. And yeah, it's similar with a lot of the offshore. Everyone wanted to be computer engineers and not petroleum engineers, and that's going to bite. I interviewed Professor Mike Kelly, and he's like a guy that's one of the few guys that's gone through and done all the numbers on all the grid infrastructure and what it would cost to upgrade it all for EVs, and just done all the hard numbers. And after halfway through the interview, I was like, "Oh, so you've just gone through each of the commodity constraints. Like, we need this much copper, we need this much nickel to build this out. Like, what's the biggest constraint?" And he was like, "Specialized labor." But there's just not enough people, even if one country could stockpile all the commodities it needs, they wouldn't even have the people to know how to implement it all. And it's yeah, it's kind of interesting. I was trying to explain to someone the other day, they were like, "Oh, we'll just work around this one problem with EVs and it's fine." I was like, no, it's so multi-layered, because not only do you have the constraint for the materials to go into the EVs, you then not only the EVs competing for those materials, but the infrastructure for the EVs are competing for that same materials. And then the renewables are also competing for those same materials for the backup storage. So it's just, yeah, everyone's fighting over the same pile. And without it, they all are just wildly uneconomic. And you go back to the late 1800s and early 1900s, where EVs were actually the main mode of transport for a while there, and they just got too expensive compared to internal combustion engines, and just went out of fashion. And I see like a kind of crunching the numbers, I was like, oh, unless we have some serious breakthroughs, I kind of see us hitting that road again, bar some examples where they make a lot of sense, like kind of like short range taxis in a city like that. That sort of stuff makes a lot of sense. But trying to get the range out of EVs and the amount of additional materials like trucks make no sense to me looking through them. Yeah, sorry, it's going off on a tangent.
No, that's good. I like listening, because like when I think of things, and I always think I use the word embedded energy a lot too. I look at all this stuff and I'm going, well, where are some like arbitrage plays? Because even if you've got a deep sea drill, or deep sea drilling drill ship, maybe it's one of those floaters or whatever, they still need a lot of parts. I mean, those are big pieces, and they need things fixed. They need things updated. They need a lot of maintenance. They need new parts. And then it's like, well, they're going to be paying a lot more for their parts as well. And it's like, how do you go back? And maybe there's some arbitrage play where, let's say, energy in the world doesn't get distributed evenly. So think of it this way. Let's say energy gets short, and it's like, okay, we're short energy, and everybody's like, yeah, duh. But it's like, well, what happens when energy gets short? Your export capacity drops, right? And then you could look at, and I'm just coming up with an idea, just talking to you right now. Let's say Europe just gets hit really hard, and maybe they've got a lot of aluminum smelters. I'm just gonna take a guess, right? Maybe aluminum and aluminum smelting in America may do incredibly well versus, say, Europe or somewhere else where they might be very short energy. And as the exportable capacity kind of drops down, the value may not even be necessarily the drill ship to get the energy. It might be the physical things that a lot of countries can't produce anymore because of the unevenness of how this energy will be distributed in the future. And I just keep like thinking through, I'm like, where would a low risk, high opportunity, extremely valuable items be produced that everybody wants? And you know, I'm trying to find exactly what you're trying to find, which is what is going to be the best sector to be in where all that value or money chases. And I know playing directly energy is one of the things, but I'm trying to think, you know, if energy got super scarce, it's not energy that's necessarily valuable. It's the things that energy produces, right? So it's the food that energy produces. It's the whatever it is that the person wants. But obviously, energy is the most direct play, and I'm totally on board with what you're saying. I'm just trying to think if there's any other ways that aren't directly energy played that could just absolutely do insane stuff. Do you have any ideas around that? I know you've got tin, but you've got anything else?
I love that idea because it's kind of like they like sort of
No one's
the
thinking about it.
geothermal, like as you were saying that, I was just thinking like because I was looking at aluminium a few days ago, and it just fascinates me that a lot of the EV infrastructure is absolutely, and some of the solar is hugely reliant on aluminium because it's light, and especially EVs because you obviously got the weight of the battery, so you need a lot of aluminium. You can't have a steel chassis because you need to keep up. You need to reduce the weight so you get the additional mileage, so it's comparable with ICE vehicles. And yet aluminium's so bloody energy intensive that it's one of the hardest things that I've been really frustrated is I can't find good numbers on like the different energy embedded in different things. I'd love like to find a good resource on that. That's so hard to find. It's just like no one wants to even accept like the figures for certain things. Like it's just like we'll just talk about the battery and the EV. We're not going to even acknowledge that the whole aluminium chassis required a whole shitload of carbon.
So here's the thing.
Solar, they do that with just with the polysilicon. They just like pretend polysilicon turns up at the factory and we'll start the process from here. We're just going to ignore that whole downstream, massively carbon intensive process. Yeah, but yeah.
So I was going to say, so I'm in aerospace. Everything in aerospace is weight, right? So I'm thinking like 4 steps ahead of everyone else or trying to. So when you get at energy and energy becomes very expensive, what do you think everyone's going to want to do? They're going to want to lighten everything they possibly can to make things a lot more efficient. So when I think of things, I think carbon, graphite, aluminum, like anything that the aerospace industry is doing is going to migrate into cars, into absolutely everything where possible, because anything that needs to be moved is going to cost a lot more money to move it if it's weight. So it's like, how can we lighten these things up? What's going to be highly sought after? And aluminum, which is again very energy intensive, and if it's very lightweight and everybody's going to start moving from steels and all these other things over to carbon, aluminum, and all these other types of metals and stuff, I just think there's a huge opportunity there for some type of investment that people aren't thinking of right now, because you're coming from an energy surplus world going to an energy kind of, we'll say, a more energy constrained world, and things might just completely get turned around, and that people just aren't thinking about because we're coming from the old paradigm to the new paradigm. And then there's light bulbs go off in your head. You're like, wow, why didn't I think of investing in this? This is just going to blow up. It could be graphene for all I know, right? Maybe graphene is going to be the most like just insane area to look at, because people are going to say, well, we've got these big, trucks and we've got all these big things, but we're going to be literally making these pods of graphite to send down rails or something, singular pods on how, I don't know, I'm just making something up. But maybe there's something that's coming out that we're just not, like, we're kind of missing. That's going to be like the next biggest boom. That is the new paradigm versus the old paradigm of what we're kind of looking at. Everyone's looking at the old paradigm, trying to project forward. But I'm just wondering if there's anything that you've been thinking about or looking at that's just kind of like out there.
Yeah, I've got a few of those. Problem with them is when you go into like the niche metals, like I love that and I always find it super intellectually stimulating, but it's just the execution part. Like you can get so screwed up by someone tells you like few that are coming to mind, automatics like tungsten, like vanadium is a really interesting one. Some of those like that can just a little amount can have a really like big like vanadium is really interesting with the multiple angles. I think you got the steel, strengthening steel or aluminum. You've got the redox flow batteries, but it's just like trying to get involved in like mining projects and working out like it's not my specialty. Like I like the upside story, but so many ways to go wrong, and I'm just not that smart. Like I like just going in post bankruptcy, and then it's really hard for me to screw it up. Like it's just I just try and yeah. So always my number one is just try not to fuck it up in the first place. Try and keep the capital in play. But like I feel like I can come up with some amazing narratives for some of the stuff, but yeah, it's damn hard to make money from it. Yeah, maybe some of them. I've had some. Someone could look it up in my Twitter feed. I like had this big debate on like helium. Went through, found the top like 3 helium plays, and then just completely passed on the sector. Said like these are too small. I don't think these will work, and just passed. And I think one of them was raw helium. It was up like 30x within 6 months to a year. So yeah, there's definitely those, but yeah, a lot of it's just in the too hard basket, and you've got to be to make money over time. You got to be so comfortable with like the too hard basket. Like yeah, there's nothing wrong with stuff running on you that you just couldn't wrap your head around, and yeah, it's like kind of the mining space in general. There's just a massive chunk of it that you have to be very wary of the too hard of like getting sucked into stories, because every mineral has like a really attractive story. Like even if you type in graphite or graphene, there's like 20 people on YouTube that are telling you it's like the next fucking raging bull market for, and you just look at the dates on the videos and it's like 2016, 2017, 2018. It's just it's like the gold bugs. They just go round and round and round, and they'll probably be right someday, but yeah, I'd like to have made a lot of money, and in the meantime by just doing simple, understandable, buying big lumps of cold hard steel out in the ocean that no one can replicate. And I think the day rates are going to go nowhere but up for the next few years. And uranium, which is just uranium is really just a simple supply demand. X number of reactors, X number of pounds required. Yeah, got to pull it out of the ground for X cost, and until it's there, yeah, going to have a lot more upside.
Yeah, you have to go out on the speculative forefront on
Yeah.
a lot of these companies because they don't make any money and they don't have the infrastructure in place, and it just the risks just start piling on, and you're like, I'm good. I'll just go over here where it's easy. They're
Well,
already making money.
if I'm going to go speculative, because I've got a lot of that in me. I've got a decent whack of like sort of like they're out December 24, like sort of 170, 180, 200 strikes on oil, and I just like those because you got so much time frame to catch some silly blow off. You not only do you catch the price move, you also catch the vol on the option. You don't get you dodge all the sort of the intervention. Like no one can actually, if anything, intervention actually helps you with when you've got a straight call on the commodity itself. So if I'm going to go speculative, I want to try and remove as much of the surrounding sort of the surrounding issues, because yeah, it's the thing I see most people get stuffed up on is it's like there's a few names on Twitter that just get chucked around, and everyone's like half of Twitter absolutely loves it, the other half is hating it, and they're just shouting back and forth at each other. And Rarely someone asks me, what do I think about it? And I just said, oh, like, I'm sure there's asymmetry in this, but there's also a big downside. And when I compare it to this thing, I think the asymmetry is a coin toss, which is bigger, but I don't have the downside, and there's just a whole lot less things that can go wrong for me. So I'll just take that bet every day of the week. It's kind of the idea of just constantly having like I've got this theory that I always stick to quite tightly. It's got like a hurdle rate within my portfolio. Like for a while, it was a few years, it was just physical uranium, and then I switched it over probably a year or two ago now to Whitehaven, just saying like, I don't understand how I screw this up. Like no debt, cash flow, buybacks, dividends. Yeah, I don't understand how this gets screwed up. And yeah, if you've got that kind of that philosophy and keep all your capital, so many people just chase so many shiny speculative things. Like I bet there's a few people that have just got a whole portfolio of potential 100 baggers, and yeah, none of them come home. Yeah.
Mm-hmm. Yeah. I don't really have anything else to ask. Do you have anything else that you'd like to add yourself?
Not
Or
really.
anything
Just do the work. Yeah, just do the work so that you got the conviction for whatever comes down the line. That's always the hardest thing is yeah, it's all easy to get excited about stuff when it's working. It's hard when you have a monster drawdown. And I think we all pretend that we're better in drawdowns than we are. Like I kind of in March 2020, like I've done countless hours like working out all this stuff, and I still had my stomach churning, and I put in a big order and saw it get hit, and I wanted to try and log in my account and cancel it. I was like, no, it's got cut in half again. Like I can't, and that was like down near the bottom and like the best purchase. But at the time I would have 100%, I would never have been able to put that trade on like with my, like it would have just been too painful. Like the pain trades always the most profitable, but it's damn hard to do it in the moment. And so the more work you can do and the more sort of systems you can put around so that you don't, yeah, when things get really busted up, that's why it's lovely not to have any leverage in the account, so you can just not just go and walk the dog. Yeah, like just don't look at the account for a while, and be able to ride through that volatility. Yeah, that's my main. Yeah, I think a lot of it's just overcomplicating. A lot of this just get on a good trend, stay on it, and have a good exit plan. And don't listen to the thousands of market strategists out there that are just collecting a salary and don't really have any skin in the game. Yeah, it's kind of sad. It's sad when you think about it. When you're like, I was talking to someone the other day, and they were like, should I select, like they're talking about some robo advisor? Should I? I'm pretty risk adverse. Should I choose the risk adverse, the medium, or like the aggressive version within the robo advisor? I was like, well, can you send me like the screenshot of what's in each? And the risk adverse version is like the standard 60-40, and you get absolutely fucked up. So going with the risk adverse, you're getting absolutely trashed, and with the aggressive, you've actually done fine because they removed the bonds, and the bonds are where you've had a rough time. So it's kind of a cruel turn of fate that by like a lot of the risk that people, a lot of the model for removing risk is actually adding risk now, which is just, I kind of feel sorry for the mum and dads that just understanding that, and everyone's just hoping the correlation comes back between stocks and bonds. And I don't think it is. I think all the risk is now in bonds. I think
it is
again a
totally.
horrible decade. Yeah,
totally. I don't own any bonds. So and I know
either.
People were trying to. They're like, well, we're gonna get a crash. You're gonna go to bonds. I'm like, I'm not going to bonds. Like, look at the chart.
Yeah.
It's broken to the upside. Yeah, we could get a short-term pullback, but good luck riding that. Yeah. So I don't know. The way that I view risk is dependent on the market conditions, and in an increasing interest rate environment, bonds are toast. Like, and especially if you've got Japan and UK and all these areas having problems, like I don't want to touch any of that. I'd rather go sit on a bunch of lump of metal than own those things. But that's me.
Yeah, well, you've only got to look at Japan. Japan's just fascinating when, like, because that is the end game. Like if you just watch what Japan's doing, like they're just pretty much buying the whole market. They're just it's just going to a command economy. Like they've had whole weeks, and even like where they're just buying their entire issuance themselves,
Yep.
their bonds, and
They,
yeah, it's just
they said something like they were gonna use a certain amount of money in like a month or two, and they bought it all in like a day or two. I was like, oh my
yeah,
God, what are they doing? And I look at
yeah,
that and I'm just like, that market's got to be so messed up. Like I would not touch that with anyone's money. Get me out of here.
yeah.
God, and their
It's just
currency.
again, it's just this idea that we're just everyone's stuck in the same trap because no one's going to make it. Like you've always got the three ways out of having too much debt. You've got you try to deal with it with austerity. No one wants to stomach that. No politician's going to get re-elected on that. Like even with the Fed at the moment trying to rein stuff in, and then Biden's trying to push through another multi-trillion dollar package like that. They just can't. Austerities, they can't stomach it. Default, not an option. So just going to print your way out. And as soon as you understand that's the game plan for the next decade, then just again, it's that hunt for what's the most scarce money that you're not going to get bumped off. You're not going to get knocked off the trade. You're going to be able to ride it for a long time, and you're not going to get pillaged by the government. You're not going to go into some copper mine in Chile and get money nationalized, or you're not going to get like just. It gets so much harder to kind of stay on it. Like even me, I've done whole episodes on like I call it like picks and shovels, like trying to avoid it's an analogy from like gold miners, how the gold miners didn't make any money, but the picks and shovels made all the money on the side. But even that, like I still got obviously being pillaged at the moment by Australian or New South Wales government on Whitehaven now instilling this. So just managing to avoid that and stay on the trend and actually keep your gains and knowing when to step off. I always keep coming back to that. Stepping off is everyone looks back on the bubble and says, "Oh, this was my net worth at this point in time." Well, it doesn't matter if you don't realize it. Yeah, so
Yep.
realizing it and going on to the next hated sector is how you only need to do it probably once in a career, and yeah, you'll set yourself up.
And then the last question is, do you ever think Kathy Wood's time's going to come?
God, she's amazing. Yeah, I don't know. I honestly think it's one of my more important like factors, seeing just how much like sort of belief is there still in this market when you can just type ARC inflows and you just I forget what website pops up and you just see what our inflows are over 1 year, over 6 months, and over 3 months. It's kind of like it's almost like just checking how despondent that whole sector is, and she's still positive inflows on the year and turned negative on the 6 months. But she's out yesterday. I saw an article saying she's the new NASDAQ, and that look at her recent performance. I was like, what's recent performance? Like, yeah, you've gone from 30 to 40 something dollars now, but how about the sort of, what was it, 130 to 30?
Yeah.
Yeah, no,
Yeah, they're pretty bad.
Yeah, but there will always be those characters, like, because there will always be the person that's furthest out on the risk spectrum that everyone will listen to. Like there'll be some dude out there now that we'll hear about in another 3 years that has whole accounts and YOLO options on Transocean, and he would have turned 100 grand into 50 million or something, and everyone will be listening to him, and he'll be it's kind of like there's guys like that on Tesla. Some guy like put his whole bonus on it at some cheap price and then ran it up into 20 million, and then just spends the rest of time telling the world how great he is. There's always that person, but the thing is they always just go up and write it down. It becomes such a part of their whole personality and their whole self-worth that they invariably tie themselves to it. And that's what you got to be so careful of, is that you can just step off and move away, and maybe in maybe in a few years, I'm talking about buying sort of, I don't know, something completely different. I'm just hunting through property in Indonesia, or I don't know. There'll always be some hated sector where you can rotate to when the real crowd joins you, and that's just having the discipline to do that, not get caught up in ever increasing narratives. Yeah, like I've got a research report that I found from like 2007, and it was talking about like the case for a whole lot of uranium companies moving forward, and it was just fascinating because it was just fact after fact of like how much uranium was going to grow, how important it was for the world, how it was like all correct, and it just got absolutely decimated. It's kind of, I think there's another example which was some of the .com names, how they were, I forget which one it was. It was one of the bigger companies, and they were saying like, we're going to grow revenues for the next decade. We're going to be the backbone of the internet, and they did it all. And they still got chopped like 85%. It's just, yeah, knowing when to step off, because once the narrative's like fully priced in and more than priced in, like then you just can't be there. You got to be somewhere else. That the valuations are sort of hated. Doesn't matter how good the story is.
All right, well, that's all I've got. So yeah. Thanks for coming on. I really appreciate it. And
no worries at all. Love being back. It's first. Been having a break for the last month, so I haven't even.
It's because of you had your little bub.
Little bub. Yeah, new place. Yeah, just taking time away from the screens. Apart from, can't help myself but do a little bit here and there, and also walking the bub at 5 a.m. allows me to give me a bit of sleep, so I get through a few podcasts and stuff now. But yeah, no, it's nice to start getting back into it now.
Cool.
But no, thanks for having me on. I love this.
Yeah, thanks for coming on. And if you guys want to follow him, go to Twitter. It's at TraderFerg. So
fantastic.
So we got. Thanks, guys.
Yes.